Welcome to The Explainer. Today, we're doing a deep dive into something pretty groundbreaking for the Sri Lankan market, DFCC Bank's new GSS Plus bond. What's so interesting is how it's trying to blend some really attractive financial returns with a genuine, sustainable impact. So let's get into it.
Okay, first, let's talk scale. We're looking at a major capital raise here. DFCC Bank is kicking things off with an initial issue of 7 billion Sri Lankan rupees, but they have the option to take that all the way up to 10 billion. That's a serious amount of capital, designed to fuel their next phase of growth.
Now here's where it gets really interesting. This isn't your standard green bond. It's what they're calling a GSS Plus bond, and that plus is the key. It gives the bank way more flexibility to fund a whole range of projects. Everything from green energy to social initiatives. It's a structure that's pretty innovative for the Sri Lankan market.
So here's our roadmap for this explainer. We'll start with the big picture, this new investment frontier. Then we'll decode the actual bond offer. After that, we'll look at the sustainable impact. Then we'll unpack the single most critical risk. And finally, we'll cover the bottom line for any potential investor.
Right, so this bond is designed to do two main things. First, because it's a Tier 2 instrument, it helps strengthen the bank's own financial safety net, allowing it to meet those strict international banking standards known as Basel III. And second, it channels that money directly into sustainable projects that are meant to grow the Sri Lankan economy.
Okay, so that's the high-level strategy. But if you're an investor, what's actually on the table for you? Let's decode the deal and see what the numbers look like.
Investors get a choice here, which is always nice. You've got 3 different options based on your time horizon: a 5-year, a 7-year, or a 10-year bond. And as you can see, it's pretty straightforward. The longer you're willing to commit your capital, the higher the annual interest rate you lock in.
And this chart really puts that into perspective. That 12% you get on the 10-year bond is a significant step up. We're talking over 2.3 percentage points higher than a comparable government bond. That extra bit of return, that's your premium, and it's there to compensate you for taking on a specific risk, which we're going to get to in just a minute.
But here's the thing. This bond isn't just about the yield. It's about where that money is actually going. This is the heart of that GSS Plus label. So what does it really mean for the kinds of projects getting funded?
So, unlike some of the bank's previous more narrowly focused green or blue bonds, this GSS Plus framework is more like an umbrella. It lets DFCB be much more agile, allowing them to fund a really broad range of projects that tackle all sorts of environmental and social challenges across the country.
And you can really see that diversity right here. I mean, the funds can go to anything from big renewable energy projects like solar and wind, all the way to social programs for clean water access and women's empowerment. It's all about building a more resilient economy from the ground up.
And listen, this isn't just some local project with a nice-sounding label. The entire framework is built to align with globally recognized standards. It maps its impact directly to the UN's Sustainable Development Goals, which adds a whole other layer of credibility to what they're doing.
Okay, now we have to talk about what is arguably the most critical part of this entire investment, the risk. This is the one feature that separates this kind of bond from a safer, senior bond, the kind that gets paid back first if things go wrong.
So, these are what you call Basel III compliant subordinated bonds. That's a mouthful, I know, but it comes with a very specific clause called a non-viability conversion. It's a mandatory feature for this type of bond. So what on earth is it?
Think of it like a 3-step emergency plan for the bank. If the central bank, the main regulator, decides the bank is in really serious financial trouble, that's a trigger event. At that point, these bonds automatically and permanently convert into company shares. So instead of being a bondholder, you become a shareholder, and your investment is used to help absorb the bank's losses.
And that right there brings us back full circle to the higher interest rate. That extra yield you're getting, that's your compensation for accepting this specific risk. It's the classic risk-reward trade-off. You get a higher return because you're agreeing to take a place further back in line if the bank ever faces a major crisis. All right, so with that major risk clearly on the table, let's look at the bottom line for an investor. What are the key factors that might give you some confidence in this particular bond?
Well, first up is credibility. The bond issue itself has a national long-term rating of BBB+ from Fitch Ratings. That's an independent assessment of its credit profile, and it basically signals a solid investment-grade instrument, at least within the local market.
And the credibility doesn't just stop with the credit rating.
The entire sustainable framework, the rule book for how the money gets spent, has been independently audited by KPMG. This is a huge deal for accountability. It ensures that the impact they're promising is real and can actually be verified.
Now, this next point is absolutely crucial. Who can actually buy this bond? Well, this issue is restricted to qualified investors, as defined by the Colombo Stock Exchange. So we're talking about institutions like banks, insurance companies, and fund managers. It's not being offered to the general public.
So let's just quickly summarize the key facts for your dashboard. The issuer is DFCC Bank. The issue opens on February 6th, 2026. It's going to be listed on the Colombo Stock Exchange. And remember, it's a rated, unsecured, subordinated Tier 2 bond targeted exclusively at qualified investors.
And that really brings us to the big picture question here. By pairing these really competitive yields with a sophisticated, globally aligned impact framework, is DFSC about to set a new standard for what sustainable investing can and should look like in Sri Lanka? It's a really compelling model, and for sure the market will be watching this one very, very closely.